My name is Jason Bordoff. I'm the director of the Center on Global Energy Policy, professor here at the School of International and Public Affairs, and really delighted to have Antoine Halff here from the International Energy Agency in Paris. Antoine, as many of you may know, leads the oil market division at the IEA, is responsible for their monthly oil market report, and then also for the medium-term outlook that he'll talk about today. And for me, it's one of the documents it's working still? One of the documents I most look forward to getting from the IEA, in addition to the month-by-month sort of how things are changing on the ground, and then the very long-term view that you get with the World Energy Outlook, the really rich detail that you find in the medium-term report that tells you where the oil market is today and where it's headed for the next couple of years, and how the situation on the ground in key regions is changing on the supply side, on the demand side, with regard to oil trade flows, is really a very interesting and enlightening piece of work. So really delighted Antoine could be here today. I won't go through his whole bio. He's been head of the oil market division at the IEA for the last couple of years. Before that was with the EIA, the Energy Information Administration at the U.S. Department of Energy, where I was lucky enough to learn from him when I served in the administration, and has held many other energy analyst positions before then, including founding the energy practice at the political risk consultancy Eurasia Group here in New York. So please join me in welcoming Antoine Halff to Columbia.
Good evening. Thanks, Jason, for the introduction. Thanks for the opportunity to be here and talk a little bit about some of the work we've been doing at the IEA. It's great to be at Columbia. I used to teach here for a few years. I love the center. It's getting even more dynamic now under Jason's leadership. And it's great to see some friends and colleagues, Taki and Roy Nessersian, one of the greatest experts on LNG and marine transport. So very nice to see all of you. And very impressed that so many of you are here tonight on a summer night. So since we're not such a large crowd, I think if you want to not wait for the Q&A session and interrupt me, feel free to raise your hand and ask a question if you'd like during the next few minutes. What I'd like to do is essentially start by going over some of the key messages from this annual outlook that this kind of medium-term outlook we do every year. It's called the Medium-Term Oil Market Report. And the last one came out on June 17th. It's a look at the market, at the oil market for the next 5 years. So it's a kind of bridge between two other much older and established IEA publications, which are the Oil Market Report, which is a monthly look at current or short-term market conditions, and the World Energy Outlook, which is a much longer-term kind of scenario exercise, looking at different scenarios for the energy market as a whole, not just oil. So some of the key findings, and again, this is something we do every year, so there's a kind of repetitive nature to this exercise by definition, because we go over the same thing every year, but every year things change. And I assume you probably don't know our report of last year, so I won't dwell at length on how this year compares with last year's. But just to put it in a nutshell, when we look at the oil market in the next 5 years, we are forecasting a growth in oil supply, which is quite steep, at least on paper, and which is a little bit steeper than the growth that we expect in demand. So that's similar to what we expected last year. We are forecasting a market that's becoming a little bit more comfortable, a little bit looser, but we're not seeing the same kind of easing as last year. So we're kind of bearish, if you like, but we're not quite as bearish as we were last year. And I would put bearish in quotation marks because there's many caveats and many risks to the forecast, and they're all on the upside. looking, and this kind of loosening of the balance, I should emphasize, is really a change in the narrative compared to the dominant theme in the market just a few years ago, at least until the Great Recession, when the major concern in the market was scarcity, right? When prices were going up in 2008 to what was at the time a record, which has been now passed many times over for Brent. But at the time, the great concern, the great dominant narrative was oil scarcity, competition for scarce resources, and so on. The theme has completely changed now in the market, and the theme is abundance. But this abundance is somewhat misleading or elusive, and there's many risks and many concerns around this story. So, looking at the supply side, and I go over those themes just in a little bit more detail in just a second, but just to go through the list, looking at the supply side, what we see is a continuation of the theme of the just last couple of years, with a surge in US and North American non-conventional production, light tight oil in the US, oil sands in Canada. So we see that continuing in the next few years and really being the major source of incremental production. But there's a couple of changes over the time period, over the forecast period. One is that we see a slowdown in the pace of growth in North America and in the US. Growth continues all the way to the end of the decade. But by the end of the decade, we see slower growth than we have seen in the last few years and that we see in the next couple of years. That's one. The other thing is, just as growth starts slowing in our view in North America, we see the light tight oil story picking up outside of the US and outside of North America. So we're expecting to see a little bit of a light tight oil production coming in from places like Argentina or Russia, or even perhaps at the very end of the forecast period, Mexico and Australia. And that will be the beginning of a trend that will pick up momentum in the next decade. So it's not a huge story for this forecast period, but it's a significant development. It's a bit of a turning point. So, the light tight oil story, many people have said this is an American story, it's a US story, could never have happened anywhere else than in the US. True, but looking forward, it starts changing and it becomes more a global story, less an American story, less a US story. At the same time, as we see this growth in North American supply, which really has been a game changer, and we continue to send ripple effects through the market, through the supply chain, in many, many ways. At the same time, we see concerns and problems with conventional supply, particularly coming from OPEC. So we are forecasting some capacity growth from OPEC, but that capacity is increasingly at risk from above ground factors, instability, political violence, and so on. And much of the growth that we expect from OPEC, we see coming from one country, Iraq, and that country, of course, now is a little bit at risk. There's a lot of uncertainty about this forecast. This is a forecast that we have developed, by the way, before the start of the ISIS campaign in northern Iraq. So we tried to reflect these developments in our commentary because we published on June 17th, but we haven't factored in any adjustment in the forecast, in the numbers, in view of these recent developments. Now, on the demand side, we also see some changes, and just like in supply, there's many changes happening at the tail end of the forecast. So that's why our forecast this year is a little bit different from last year, partly because so much happens at the very tail end of the forecast, and also because of all the events that happened this year that have changed things a little bit for the rest of the period. But on the demand side, we see continued growth, and actually a sort of acceleration of growth in the next few years as the global economy is forecast to recover a little bit more strongly, and we use the IMF forecast as an input. Now, that forecast might change, and there might be revisions to that forecast, but that's what we've assumed in our modeling exercise. But towards the very end of the period, we see for the first time a significant impact from environmental regulations, from efficiency improvements, and from fuel switching out of oil, not just in the traditional sectors where oil has been competing against other fuels, which is stationary uses like power generation or industrial uses or space heating, but also in the transport sector. So that's kind of a new development, that oil no longer has a monopoly on transportation fuels, and increasingly towards the end of the forecast period competes against other fuel, specifically against natural gas. And this is both in the road transport sector, in the marine transport sector, and also in the rail transport sector. Finally, a key point is that there's many implications from these developments for trade flows, and for the downstream. A lot of the supply growth is coming from the Western Hemisphere, from the Americas, from North America, from Brazil as well. Most of the demand growth, in our view, comes from the east of Suez region, from the Middle East, from Asia. Asia becomes the magnet for virtually the great majority of the crude that's being traded internationally. We expect North America to become a net oil exporter by the end of the decade. So this is much sooner than previous forecasts had expected. Last year, in one of our reports at the IEA, we expected that to happen in 2030. We now think by the end of 2019, North America will be a significant net oil exporter. Whether it's going to be crude or products, that's another question. But the balance, in our view, is that North America is going to be long oil and will be shipping oil to the world. And the imports will increasingly converge towards Asia. China today is already a larger crude importer than the US for the first time, and that Asia in general will increasingly take over from the Western Hemisphere. The non-OECD countries in general will increasingly overtake the OECD countries in consumption and also in importations of crude. And the refinery industry continues to go through a major restructuring. There's a major transformation affecting the refining industry. It's not just about crude oil and product demand. It's the whole supply chain in between is going through a major transformation. That was already something that we had spotted last year, but that continues and that picks up momentum. That changes, the story changes a little bit. We have significantly reduced our forecasts of incremental refining capacity. There's less refinery expansions today, in our view, for the next 5 years than had been expected last year. Nevertheless, there's growth in excess refining capacity, which means that this is putting pressure on some of the older, less competitive, more obsolete refining capacity to close down or to get out of the market. And this has all kinds of implications for product supply and also for energy security, particularly in Europe, but globally in the world in general as well. So let me just go over some of these points in just a little bit more detail. I'll try to go quickly because I think it would be nice to have more questions and answers and less my pontificating. So looking at where demand is coming from in terms of the regional breakdown, what we see is that most of the demand growth continues to come from Asia. This has been the trend in the last 10 years. But we see, and Asia really accounts for the largest increment of demand, of oil demand in the next 5 years. But the pace of demand growth in Asia is slowing significantly. That's largely driven by China. China is shifting gears in terms of economic growth and also in terms of energy consumption, and particularly oil consumption. There's a very deliberate effort, policy-driven, to cut back on oil consumption, to rein in consumption growth for many different reasons. And we see that as having an effect on the consumption patterns of China and India and Asia in general in the next 5 years. The Middle East, on the other hand, continues to grow, and growth there accelerates. It accelerates because of economic growth, oil revenues, population growth, and also spending. Spending in the Middle East is very high. in our view, will continue to be high, except in places which are affected by war or deep turmoil, like Iraq currently, where we have reduced our forecast since we published this medium-term report. We have reduced our short-term forecast of Iraqi demand in view of the events there. So by the end of the forecast period, we do see a slowdown, and that's, as I mentioned, and that's kind of a new development. Africa is also a region where growth is very, very steep. Now, it's very steep, but from a very low base. The baseline of African demand is quite low. Consumption per capita is extremely low, but growth is very steep. The African economies, on balance, have been among the fastest growing economies since the recession. And that's by official measurements. It's quite likely that the real growth is even much steeper than statistical data suggests, because first of all, statistical collection statistical capacity is quite reduced in the region, and also because so much of the economy is not fully above ground. But we do see, for instance, in anecdotal information about product imports into Africa, huge consumption growth. We expect that to continue in the next 5 years, which would be very important in terms of trying to find an outlet for refined products from various sources, including the US. Looking at demand now by sector, by type of fuel and by type of economic activity, growth continues to be driven by the transportation sector. That accounts for more than 50% of oil consumption, and the share continues to increase over the next 5 years. Consumption for stationary uses, for power generation, for industrial uses falls everywhere except in the Middle East, where we see an increase, because power generation, electricity demand in the Middle East grows dramatically, and most Middle East countries will try to satisfy this demand growth with natural gas, but natural gas availability will not be sufficient to meet this demand, and there will be growing consumption of residual fuel and direct crude burn for power generation in the region. What we do see is growth, quite significant growth, in non-energy related uses of oil, specifically petrochemicals. This is something that's not always fully captured, but this is very significant. There's very steep growth in petrochemical demand for oil. This raises all kinds of problems because there's also growing integration of petrochemical facilities with refineries. So when we look at the refining industry, when we look at refining margins, it's increasingly now misleading to look at it in a traditional way, just looking at the price of traditional refined products without taking into account the downstream petrochemical sector as well. Most refineries nowadays, especially the new refineries being built in Asia and the Middle East, are increasingly integrated with petrochemical facilities, and it's becoming really a single vertically integrated activity. We're not fully equipped to measure this and to capture this in our economic analysis, but we will have to. That's one of the challenges that we have for the next few years. But growth of petrochemical demand is significant. It comes mostly from Asia and the Middle East because of consumer demand. People consume more and more petrochemical-based products, plastics, and so on. In the US, it's also driven by the supply side, by the availability of petrochemical feedstock as a byproduct of natural gas production, oil production, like condensates, NGLs, all these things are feedstocks for petrochemical plants, and that's why we're seeing in the US such a strong revival of the petrochemical industry, which just a few years ago seemed to be on the way out. But in the transport sector, which is the dominant sector, we are seeing some erosion at the end. We see natural gas making inroads into the road transport sector in the US because of, for economic reasons, because there's so much natural gas looking for a market, and also in China, there for policy reasons, for environmental reasons, because the government is trying to clean up the air and substitute high emission fuels with lower emission fuels. So there's a strong push for natural gas there. And those are the two countries where we see the greatest progress in natural gas for transport, but there's other countries where we see some inroads as well. And we see some gas used in the marine transport and some gas used in the rail transport sector as well. On the supply side, growth on paper is 9 million barrels per day of capacity globally. This is partly misleading because not all of that capacity might be available to the market. Last year, we did not adjust our estimate of production growth for the amount of capacity within OPEC that may be technically capable of producing, but in practice may be off limits to the market for various political or other reasons. For instance, during the Libyan civil war, a lot of Libyan capacity was off the market because of the fighting, then came back when the civil war ended. So we at the time, we thought that adjusting capacity and trying to assess effective capacity as opposed to notional capacity, that made sense for the short term, but that might not make sense for the medium term or longer term. We changed that view now in light of the very steep, significant, lasting disruptions in Libya and elsewhere that we've experienced over the last few months. So we now came back to the view that a lot of the capacity in OPEC might not be available to the market, not because it can't produce technically, but for other reasons. And that's going to be something, a feature of the market that will stay with us. So adjusting for that, we have probably a little bit less supply available to the market than appears on paper. But most of the growth is coming from the non-OPEC region, really mostly from North America. Some growth from biofuels, mostly as a result of investments that have already been made, not so much new investments, because there's a bit of a crisis in the biofuel industry worldwide. And some growth in NGLs, both within OPEC and outside of OPEC. So in the Middle East and North Africa, there's been very severe impacts on production from the Arab Spring, from the Arab uprisings that started in late 2010. Those effects have been somewhat lagged. They did not really hit the market immediately, but we've seen those effects really gain momentum over the last year. And when we look forward to the next 5 years, we've really started to cut back on our forecast of OPEC production capacity growth. We reduced our forecast by 500,000 barrels compared to what we expected last year. And this is before the latest armed campaign by Islamists in northern Iraq. This is based on factors that were evident even before that, both security issues in the whole region, especially in North Africa and even in Nigeria, but also red tape, corruption, lack of infrastructure, lack of skilled labor, above ground problems, delays in awarding contracts. We've seen those problems really hit Iraqi projects, delay Iraqi projects, and we think that's going to take a toll on production. But in our forecast, Iraq accounts for 60% of the growth for the whole OPEC region. The OPEC forecast 2.1 million barrels of incremental capacity. That's kind of in line with historical trends. What's unusual is that this is so lopsided, so concentrated into one single country, Iraq. And now that country, there's many question marks about whether it's going to be able to deliver on that growth. And we can talk about this a little bit later. There's two countries where we see contraction. And this might sound somewhat counterintuitive because they're Algeria and Kuwait. And those two countries happen to be MENA countries which have not made the headlines for political turmoil or uprising or security issues. I mean, there's been the attack on the Ain Amenas gas facility in Nigeria in January 2013, but the country has been generally stable. So has been Kuwait. It hasn't been in the news very much. The reasons why we see contraction there is because of the lack of projects, because of the political gridlock in approving changes to the investment climate that might bring in investment. So this is something that has upset the Kuwaitis in particular. The Kuwait has not been happy about our forecast and has been very vocal about its displeasure. But we don't mean to be to offend anybody, but we just haven't seen the kind of projects in Kuwait that would support a stronger forecast. Now, if Kuwait comes forward and becomes more transparent and releases details about specific projects, and I think we might see that process starting, then we might revise the forecast next year. But so far, we haven't seen any reasons to be more optimistic. We've spoken to many companies that know Kuwait from the inside, who've been also privately very pessimistic about the forecast for the next few years. Consultancies, for the most part, are more tend to see a flatter forecast outlook for Kuwait, but many of those consultancies do have Kuwait as a client, and sometimes that can have an impact on the forecast. So in Iraq, the projects that we've identified that underpin our forecast are, for the most part, in the southern region of Iraq. So many commentators in the last few days have said, well, Iraqi production is not really at risk from the turmoil in the north of the country because the Sunni Islamists will never get to the south. They will be unable to take over the Shia regions where most of the production is taking place. Therefore, Iraqi production looks relatively safe. Well, we're not really sure how safe it really is because it's clear that Islamists could, if they wanted, disrupt production in the south without physically occupying the south. Occupation and disruption are not the same thing. But most of the production growth that we anticipate is also coming from the south. So that may be a cause for cautious optimism about the capacity of this forecast to come to fruition. But there's also now, since the beginning of the events, some optimism among some circles in the market that perhaps with the KRG becoming more independent, it will be able to unlock more supply to push for projects and to export more aggressively than in the past. That's possible. We haven't factored any effect from the recent turmoil into our forecast, but that's something that we have to bear in mind. Right now, I think it's probably too early to draw conclusions from the events. The situation is still dynamic. We're not really sure how things will evolve, but certainly something to watch. In terms of the non-conventional supply, it continues to drive really supply growth globally. You see here in this graph, we color-coded production growth by region, and the kind of caramel color represents North America. That still dominates the forecast like it did last year. It's really where most of the supply growth will come from, US and Canada, but the share of this supply kind of diminishes towards the tail end of the forecast. And we see more growth coming from Latin America, that's particularly Brazil, and more growth coming from the North Sea, from other parts of the producing world. So it's a bit of a change. One significant development is that there's more and more supply that's being provided by natural gas liquids and by condensates. That's really accounting for a fast-growing share of the market, a very significant tranche of the incremental supply. This has many implications for the market because those light products have very specific yields. Don't cover the full spectrum of products that the market needs, tend to be very rich in gasoline, in naphtha, not so much in middle distillates, which is what the market needs the most, where most of the demand growth is coming from. Those condensates and NGLs also tend to some degree to bypass the refining sector. So for refineries, it's a challenge because it's competition. It's products that come to the market but don't really need to be processed through a traditional refinery. So it aggravates the kind of situation of overcapacity in refining that we already experience today, but that will become more severe as we go forward if all the production, the project expansions that we anticipate come forward. A lot of that growth in NGLs come from the US, is associated with shale gas production. Some of it comes from OPEC and from the Middle East, because Middle East countries are very determined to push natural gas production to support their need for electricity and to reduce the amount of oil and crude and resid that they burn for power generation. So there's very strong growth in gas production. A country from Iran, for instance, has been able to increase gas production through the last few years under the sanctions regime, even though it hasn't been able to increase oil production. It's been able to invest in gas, to increase gas production, and this increase in gas production comes with an increase in associated liquids. So we see that continuing in the next few years. Also growth from other Middle East countries, Saudi Arabia, UAE, Qatar in particular. So in terms of the implications for the trade map, for oil flows, for trade flows globally, it's really a very striking transformation over the next 5 years. The oil flows just shift dramatically, essentially to the east. Asian imports in the next 5 years, in our view, will surge by 16%, so they will account for 65% of the international trade. Asia will really be the magnet for the world's crude trade, and North America will become self-sufficient or even a net exporter. The amount of crude traded globally, in our view, will actually diminish a bit. Even though demand will grow, production will grow, less crude will be traded internationally, probably somewhere around 1 million less in our view, because more and more crude will be refined next to the wellhead. And this is driven essentially by two main regions. In North America, refiners, instead of importing crude, are increasingly running domestic crude, US crude or Canadian crude, which is we consider as similar to domestic crude. And in the Middle East, crude producers that used to export crude increasingly are building up refining capacity and running that crude at home. So there's less crude on balance that will be traded. There will be more products traded, in our view. And the increase in products will kind of be an offset for the decrease in crude. The Middle East will export less crude. It will be less active in the crude market, but it will still remain the largest crude exporter in the world. And Africa will export almost all of its crude production, incremental crude production, because we think that Africa will not succeed in fulfilling its refinery expansion plans, or at least for the most part. Same thing goes for South America, where we think that the very aggressive refinery expansion plans that had been announced by Petrobras, for instance, a few years ago, will not come to fruition, and Brazil will export its crude and continue to import products. So refining capacity, as I mentioned, will grow. Our forecast is that growth in refining capacity will be slightly more than 7 million barrels per day of capacity over the next 5 years. This is pretty much the same as demand growth. We think capacity, refining capacity and demand growth will expand, will grow pretty much at the same rate. But nevertheless, we think that refining capacity, overcapacity will increase. Again, because so much of the new supply in oil will bypass the refining sector. So out of that 7 million barrel plus of incremental demand, we think 2 million roughly will be met by products that will not go through refinery, biofuels, NGLs, and only 5 million will need to go through a refining system. So that means overcapacity. That means that in order for refinery utilization rates to go back to the type of level that we experienced in 2008, around 2008, which is the last time global refining margins were considered healthy. In order to go back to that healthy level of refinery utilization, we would need, in theory, to get rid of almost 5 million barrels per day of refining capacity, which is huge. And this could come from refinery closures, in markets where refineries are uncompetitive or getting too old and obsolete, or this would come from delaying projects or canceling projects. And it could be a combination of all three. But we're already seeing new plans to cut capacity in places like Japan, which just completed a first round of refinery consolidation, policy-driven, government-driven in March, and immediately announced a new second phase of refinery consolidation with almost another 500,000 barrels per day of refinery to be closed in the next few months. So there's significant closures there that appear to be on the horizon. And in Europe, several companies have made noises to the effect that they would cut capacity. Eni in Italy has announced plans to shut 3 refineries. There's many such moves, in our view, in the cards. That doesn't mean that there will be no investment in refining capacity, even in Europe. And for instance, Exxon last week announced a very large investment plan in its Antwerp refinery. So there will be losers and winners. It's not going to be all losers in Europe, but there's going to be a very significant redrawing of the map. Most of the capacity will come from China and the Middle East. We've reduced our forecast of Chinese capacity growth by a large amount, by roughly 2 million barrels. And that's kind of a new development. Plans that had been approved in China are now being revisited and cancelled. This is the first time this happens in our view. In the past, once a project had been approved in China, it tended to stick. Now we see the Chinese having second thoughts and going back on plans. But we still see a lot of growth coming from there and from the Middle East. This has very significant implications for the US. As you probably know, since the beginning of the light oil revolution, the US has moved from being the world's largest product importer to being the world's largest product exporter. And despite the prohibition on crude exports, the US has been able to export more oil in the form of refined products. That's been a winning strategy. Refineries in the US are very competitive. They enjoy very low natural gas prices, very low energy costs. Energy costs in the US refineries is about 20% of the costs. It's somewhere around 60% in Europe. So that's a very strong competitive advantage. Refineries in the US have economies of scale. They have cheap feedstock. And they've been able to compete with refineries elsewhere. That might not be the case in the future, because now, in the next few years, we're going to see super competitive refineries, giant refineries coming from the Middle East. It's already started in Saudi Arabia. There's more coming down the pipe very, very shortly. Russian refineries are upgrading and are becoming much more aggressive in exporting light products like ULSD, ultra-low sulfur distillates. They used to export crude and residual fuel oil. They're now moving to export diesel. This will be very strong competition for US refiners. So in the last 5 years, US refiners have been able to shut down European refinery capacity. This was a soft target, an easy target. The next 5 years will be much more difficult. It will be much more challenging for US refineries to compete in the global market. In terms of products, there's significant implication, product supply, significant implications from these changes. A lot of distillates will come on the market. There may be times over the next 5 years when there's a bit of a glut in distillates. This might actually happen now. There's a fairly loose market in distillates today. But we see dramatic growth in distillate production, in excess capacity, excess production, if you like, or production capacity in North America to the tune of 1.4 million barrels per day of excess capacity available for exports. In Russia and the FSU, we see 1.2 million barrels per day of capacity. In the Middle East, a surge in capacity, surge in distillates available for exports. This is massive. At the same time, Europe becomes increasingly dependent on imports. It's been dependent on imports for a long time, but this dependency increases dramatically. Africa also imports more and more distillates, and Latin America continues to import a reasonable amount. So it's a reasonably balanced market, but with much more global integration, if you like, with regions that become very large exporters and regions that become very large importers, and the two locked in a very tight embrace. Now, if we look at the gasoline market, it's a very different situation. Gasoline and naphtha, what we call light distillates. And there we see a glut. We see massive surge in US production. US has been until recently, has remained until very recently an importer of gasoline, is now an exporter, is going to be a very large exporter. The Middle East will export. Europe continues to be long gasoline, despite all the refinery closures. Russia and the FSU is long gasoline. Only Asia imports gasoline on a large scale, but there's going to be a glut of gasoline and naphtha. This is a challenge. Finding a market outlet for all this light supply is becoming a bit of a headache. And in fact, the challenge of finding an outlet for this supply is a supply constraint. It raises questions about whether refiners will be able to produce all the distillates that the market needs, because it's going to be very difficult to dispose of this byproduct, of this associated production.
You said, how different does this look if we change the export policy for oil?
So that's a good question. In our forecast, we assumed that the prohibition on crude exports would remain in place. We have assumed some flexibility in how the law is interpreted. In other words, some creep up in condensate export at the margin, but we've also factored in some constraints in terms of logistical bottlenecks in building capacity to export. If we now considered export flows of crude, it's not clear that this would make a difference. It's not clear that refineries in the US would run less if they could find an outlet for their products, because they might import heavier crude and let some of the light crude be exported, but they might not necessarily cut back on their runs. So this is a good question, difficult question to answer. This exercise of product supply and trying to forecast product trade flows, by the way, is extremely difficult to do, extremely intricate, and there's many moving parts. So it's much more complicated to do this than to do crude supply, crude trade flows. But it's unclear in our view that should there be crude exports from the US, there would necessarily be a steep reduction in refining capacity. There's actually not that many refinery expansion plans on the books in the US. There's some distillate splitters on the books, but there's not that much incremental refining capacity growth. There's been some in the last few years, but there's not that much that we expect in the next few years. So this slide kind of captures kind of summarizes what I just mentioned and tries to capture this in terms of where that leaves OPEC spare capacity. And on paper, we have an increase in spare capacity to pretty high levels of about 6 million barrels per day for the last 3 years of the forecast, which is less than what we anticipated last year, but still pretty steep. Now, if we make adjustments to the tune of 1.5 million barrels per day to that, to try to capture what's really effective, not just what's nominal, it's a smaller amount, obviously, and it's kind of the same as what we had in 2009 at the time of the recession. So that would typically suggest a looser market, possibly more downward pressure on prices. But again, a lot of this capacity is at risk. A lot comes from a lot of the OPEC capacity is subject to very significant political security risks, and that applies not just to Iraq, but also to Nigeria, to Algeria, to Venezuela. So there's very significant risks to this forecast. So we don't see that as necessarily a very bearish forecast. We don't forecast prices as a matter of policy, but we don't really see this as something that necessarily a very bearish outlook, because there's some signals that the market is getting more comfortable, but there's also many warning points, many red flags, many concerns about supply security in many parts of the producing world. So that's it in a nutshell, and if you have any questions, yes.
I was just wondering if the extra capacity that you're projecting in the producing countries is coming from national oil companies in those countries, or from international oil companies making investments in those countries?
Right. So for a large part, it's from international oil companies, from IOCs. Right? A lot of the supply still comes from North America, where it's not really national companies being involved. And in places like Argentina, Russia, IOCs are getting involved, bringing technology, bringing know-how, sometimes in partnerships with national companies, but for the most part, it's from IOCs, I would say.
I wanted to walk around the world and ask you a couple of more detailed questions about some topical hotspots, and then open it up to questions from the audience. So things that are happening in the world today. I want to ask you about the outlook to 2019, but also like the outlook today. Can you comment, you talked about Iraq being the largest source of political risk, and then you said, let's come back to that and talk a little bit more about it. So 60%, I think, of the OPEC production growth is coming from Iraq. How should we think about the global supply balance if that much supply is coming from that one particular country? What did you make of the KRG's recent takeover of a large amount of capacity near Kirkuk? And what's your overall take on sort of the situation today and how confident that makes you in the longer-term outlook?
Well, certainly it raises all kinds of questions. I think it's too early to draw conclusions, but the consensus increasingly, I think, is that the Iraqi system, as we've known it since the war, is kind of broken. It's not really sustainable. But what shape the new Iraq will take is still very much an open question. So I don't think we can really draw conclusions and speculate from the events of the last few weeks or the last month. KRG suddenly looks like it's trying to assert itself, assert its capacity to export. It's been lifting cargoes. Cargoes have been lifted at Ceyhan of KRG oil, transported through the independent pipeline controlled by KRG. One cargo has been delivered in Ashkelon, but finding a market for these cargoes remains a problem. There's still a very bitter war of words between Baghdad and KRG, and this is not really resolved. Sure, KRG has now more leverage because of its control of Kirkuk, because of its military capacity to resist the ISIS attacks in the north. So things are very dynamic, evolving, but I don't think that we can really speculate at this point about the outlook. There's not necessarily a change to the forecast. It may be that the forecast will be fulfilled even with the political changes. It's not really clear that even the partition of Iraq in three separate countries or regions locked in some kind of federation would necessarily change the reality in the oil field. The things could be exactly the same, or it could unlock more supply, or fighting could cause more delays. Right now, we've seen oil companies move personnel out of the country, so that would theoretically suggest delays in implementing projects. Companies are kind of on the fence, waiting to see how things turn out. Even Chinese companies have been moving personnel out, which is a big deal, because when China moved personnel out of Libya, this did not play out very well in Beijing. They came under very fierce criticism for having done so. So the fact that they're moving personnel even from the southern fields, which theoretically are insulated from the fighting for now, really says a lot about the degree of concern and the worries about security issues that they have. But the Iraqi personnel, for now, is perfectly capable of running production, of running the business as it is, at least during the interim period until things clarify. So it's a good question, but we can't really answer it now. I think the best we can do is just watch and see how things evolve.
I'm going to ask you more questions you can't answer. So what was your take on the sanctions announcement yesterday against Russia? What do you think the implication of what was done yesterday and the potential for further escalation into the energy sector, energy technology applications would have on your outlook for Russia?
Well, there too, we're not really sure we can change things. I mean, it's on the one hand, you have the situation in Ukraine and the conflict or the tension with the West over the situation in Ukraine. At the same time, it's quite remarkable to us that there's been a kind of a sea change in Russia's oil policy. In the last 15 years, or 10 years, since the beginning of the oil rally back in 2002, 2003, the trend in Russia had been a trend towards greater resource nationalism, raising taxes, raising royalties, putting pressure on some companies to get out of contracts that they had secured. The same applied to places like Argentina, where companies have been expropriated. And lately, since the light oil revolution, since the unconventional revolution in North America, we've seen a reversal of that trend in many countries, especially countries that have a very large shale potential or non-conventional potential. So Russia has kind of reversed course on its resource nationalism and has made it possible, has changed the tax regime in the Bazhenov shale play in a bid to attract investment from foreign companies to bring in technology and to really unlock this resource. And this is really working. Companies have been investing. There's many companies now in the Bazhenov looking at developing various sections, various segments of the Bazhenov. Very large investments have been committed. And even since the Ukraine crisis, we've seen companies double down on their investments and really sign promises, sign deals, sign
so you haven't seen a chilling effect? So
we haven't seen a chilling effect in the oil sector. The noise level has increased in the political level, but in terms of the industry, we've seen greater commitment, greater interest from companies to get involved in the Russian
and you wouldn't expect that to change with yesterday's move, which affects the ability for Rosneft and Novatek to raise debt, but people can still do business with them.
Right. So the question is, what is the tipping point where sanctions really start biting and start slowing things down? But I'm not sure we've seen it yet.
Iran, we don't know if and when any deal might be struck, but if it were, can you talk about how quickly you think production could be ramped up again in the country? How much damage has been done? What assumptions do you have for Iran in your medium-term outlook?
Okay, great. So you're great at finding questions I can't answer. We've changed our forecast for Iran, actually. In our forecast, we assume that the sanctions remain in place. Not necessarily that we believe they will remain in place, but it's just the best assumption we can use, the most defensible assumption we can use just for forecasting purposes, modeling purposes. So we assume the sanctions remain in place, but despite this assumption, we have raised our forecast of Iranian production compared to our previous forecast. Last year, we had expected a drop in Iranian production capacity. Now we expect production capacity to remain flat. The reason for that is the change in the presidency in Iran, the election of Rouhani since last year, and the fact that Rouhani and his oil minister, Zanganeh, have been trying to apply a more professional approach to the oil sector than had been the case under Ahmadinejad. So one of the things that Rouhani has done, or the oil minister has done, is try to get rid of the revolutionary guards, which under Ahmadinejad had really increased their lock on contracts in the upstream and have not been very effective, not very professional, often corrupt, and in our view, we're paving the road for a decline in production. So now with those guys getting sidelined and a more professional approach to the oil sector, we see, even under a sanctions scenario, we see production staying flat, managing to staying flat instead of decreasing. Nobody knows for sure what the impact of the sanctions has been on production capacity in the long term. There's different theories out there. Some people think that there's been permanent damage to capacity because the fields have been shut down in an unsound fashion, and this has caused damage and basically permanent damage. Others think that it's the opposite, that because of the forced shutdown of some fields or reduction in production, it has allowed the fields to rest, and it has restored some pressure to the fields, and basically Iran will come out in a stronger position to come back to the market. It may be a combination of the two. It may be a case-by-case situation where some fields have been damaged, some fields have been are in better shape and maybe stronger. I don't think anybody has the information needed to make a judgment on this. So we need to see. But even if sanctions were to be lifted, first of all, there's various layers of sanctions, and not all of them may be lifted at the same time. It might take some time for a lifting of the sanctions. This might be a gradual process, a difficult process involving many different political forces, congressional elements, not just presidential, legislative, as well as the executive and so on. So this may take some time. It will, in our view, take time for a lifting of sanctions to really translate into more production capacity. Investments will take time to get in. It will take time to do maintenance on the fields, to bring things back up to speed. So we don't think that even in an easing of sanctions, there might necessarily be a very strong ramp-up in production. Others have different views. Some people think Iran could easily ramp up production by 1 million barrels per day within a year. That seems to us a bit of a stretch with things on this floor.
I'm going to keep walking around the world to one or two more places before we open it up. So Latin America, you guys are, I think, somewhat optimistic about the outlook for Latin American production, particularly toward the end of the forecast period. Mexico and Brazil feature prominently in that. Those areas have disappointed a little bit relative to what some people thought in recent years. We, as people know, have Adrien Lejeune, the former Pemex CEO, as a fellow at the center, who recently wrote a paper about how significantly more challenging it might be for Pemex to undertake these reforms than some people think. So can you talk a little bit about what drives your optimism and what you think caused some underperformance in recent years?
Well, a lot of the growth in Latin America, I think, will come from Brazil. And there's been high expectations that Brazil would be a large producer. And this has been, it has not been realized in the last few years. There's been many delays, many cost increases, many disappointments. But we think now Brazil production is on course, is on track to increase. It's actually been increasing this year. We've seen some significant growth already. We think growth will continue. It's been a delay. It's not been a failure. Part of the delay has been due to policy issues, above-ground factors, particularly the local content requirements have been very challenging, very constraining, and very costly. And costly just because they've caused a run-up in prices, in costs. There's been a lot of cost inflation in Brazil. Cost inflation is more subdued now. Prices have come off a little bit. And I think Brazil will be more flexible in implementing its local content requirements. And also companies have adjusted and have made the different steps which have caused delays, but now things look on track, and production to us looks like it's going to grow and be quite successful.
And also, I was going to move to another part of Latin America, but also in Argentina, we've seen some shale oil production actually start to occur. And I just want to get your take on that. Do you think that's going to grow? Is that maybe the first area outside North America where you think shale will really take off? What does that tell us about the...
Yeah, quite likely. I mean, there's a very strong potential there. There's some challenges, particularly water. Getting enough water to inject is an issue. But the country, again, had been very nationalistic, had driven out investors. Now they quickly reached an agreement with Repsol to get the expropriation of Repsol behind them, and investors are coming back. So there's great potential.
So you think they've reversed any damage that was done, and investors are comfortable going back there now?
Well, I think the prize is so tantalizing that it's kind of muting concerns that investors might have otherwise. And we're expecting some growth. By the end of the forecast period, we're assuming growth about production about 100,000 barrels per day of light oil from Argentina. That being just the beginning of a trend, which will pick up momentum in the next decade. In Mexico, we don't see that much growth. Mm-hmm. I mean, the Mexican reform is a very important development, one of the biggest developments in the oil sector, certainly for Mexico. First time since 1938 that investors are coming in a big way. So it's a big deal. We don't really see that having a big effect in the next 5 years. It's going to take longer. It's more for the next decade. So we see a little bit of an impact initially, early, easy, low-hanging fruit being picked first. Then maybe a little bit of fallback as investments take time to really make an impact. And then towards the end of the period, we see some growth. A tiny bit of growth probably in shale, light oil. But the real growth, in our view, is going to be in the next decade.
We've seen remarkable price stability in the oil market in recent years. I was wondering if you could talk a little bit about why you think that is. Is it a coincidental U.S. increase has offset the global disruptions? You hear some people talk about how there's something structurally different about shale, that it's much more responsive, so you can ramp it up and down more quickly. Do you think that theory has much merit to it?
I'm not sure about that theory because we haven't tested it. It's a theory, but it hasn't been tested. We don't really know exactly how hedged producers are, what it would really take for production to adjust to. Sure, I mean, it's you can crank up and crank down shale production more quickly than conventional production, and it's a bit of a treadmill. You need to keep drilling to get production going. So presumably, if the price environment was unfavorable, you would stop running on the treadmill. But unless you're hedged, unless you're covered for the next couple of years, unless you have commitments, then you need to have the cash flow. So it's not completely clear that this is how it's going to work out. In theory, it sounds like a nice theory. In practice, not so sure. I think what's kept prices stable. I would say I don't think anybody knows for sure, but I would say there's two key factors. One factor has been that the growth in North America has been pretty much a match for the disruptions we've seen elsewhere. So we've seen production come off the market in Iran because of sanctions, in Libya because of the fighting, in Syria, in Yemen, in Sudan and South Sudan. But the growth in North America has been so dramatic, so steep, that it's been pretty much a perfect offset for that. The other factor, which is a little bit less talked about, in my view, and this is a bit of a hunch more than the real demonstrated theory, we haven't really done all the footwork to support that. But I think it may be because Saudi Arabia is now in full control of spare capacity in OPEC. When OPEC spare capacity was more evenly distributed amongst OPEC members, including Venezuela, Kuwait, Saudi Arabia, but also Algeria and others, Nigeria, it was, how spare capacity would be used was much more unpredictable. Some countries would cheat, overproduce, others would be slow to respond. Now, with Saudi Arabia essentially having all the spare capacity in OPEC, it's been capable of being extremely proactive, responding to shifts in demand very, very quickly. Demand goes up, Saudi production goes up, demand goes down, Saudi production goes down. And they're in full control, and it's completely predictable. The market is completely sure. I mean, it has become very confident in the Saudis' capacity to respond to shifts in demand, and I think that's been a major factor in the stability of the market in the last few years.
As you know, industry has been increasingly concerned with cost escalation and rising capex. How do you take that into account into your production forecast? What does it mean for projects at the high end of the cost curve? Do you think those are going to be challenged?
Yeah, I think those will be challenged. We've kind of pedaled down on some of the projects in Africa, for instance, which look to be very cost intensive, and we kind of see a bit of a shift in investment from frontier areas like parts of Africa to more mature places, like the North Sea, for instance, which is where there's been steep declines in the last 10, 20 years, but now it's kind of coming to a stabilizing, and even we forecast that North Sea production will ramp up next year. So partly because of the fracking technology is being applied not just to unconventional plays, but also to traditional conventional fields, both in Russia, in Saudi Arabia, in the North Sea, very effectively to enhance production, to increase production rates, to increase yields. And we see more of that, more investment being poured in mature plays, where the infrastructure is in place, where the investment climate is tested and proven, and a little bit less in very ambitious plays in more frontier areas.
Let me ask one last question, then we have about 20 minutes to open it up. Crude oil exports, as you know, is getting a lot of attention here in the U.S. Roughly in the last 6 months or so, it was many months before that your boss at the IEA flagged this issue as something we needed to pay more attention to in the Financial Times in an op-ed. There's a lot. I want to get your take on the issue generally, but in particular, there's disagreement, including in recent reports that have come out from IHS, one consulting firm, and from ICF, another consulting firm, about if the current policy remains unchanged, what impact it has on U.S. production, how expensive it is for refineries to respond, and what the production outlook is. And so some say, refineries can be pretty flexible. It won't be that big a deal in the long run. IHS had some pretty big numbers between 1.2 and 2.5 million barrels a day decrease in U.S. production if we don't change this policy. Do you have some thoughts on what the impact of this policy will be on price discounts in U.S. production?
Some cautious thoughts. There's been a lot of controversy around this op-ed piece, but I think the point that we were trying to make is very simple. It's simply that in order for U.S. production growth to continue to be sustainable, you need to have a market for the production. And at some point, if all things remain equal, you're going to bump against market constraints, because with a prohibition on exports and inherent limits to the domestic market capacity to absorb new production, you run into a problem. And you can fix that by creating new markets, and you can create new markets either by adjusting the domestic market, creating more downstream market for you all domestically, by changing your refining capacity, by building new pipelines, by extending new rail links to bring crude to market domestically, or you can build markets internationally by allowing crude to be exported. And we kind of thought that it would be really a combination of all those options, because no single option may be sufficient to address things, and it's unlikely that investors would put all their bets in the same basket. So I think we're kind of seeing that. I mean, the problem that we have is we're a membership organization. We're not there really to dictate policy to our member countries, but we are in the business of doing analysis and drawing the implications from the trends that we see in supply and demand. So I think we're likely to see more exports. It seems, there's clearly political sensitivities about removing the export ban. If you're a politician and you have a gasoline price run up, it could be a liability to be seen as having been, as being accused of having been responsible for that. At the same time, nobody wants to be responsible for killing the goose that lays the golden eggs and bringing the party to an end. So there's probably going to be some flexibility, some gradual adjustments. That's kind of what we expect.
It sounds like a pretty savvy political economy analysis, I think, on that issue. So we have about 20 minutes for questions. There's a microphone here. If folks could stand at the microphone and ask your question, just line up so the folks who are watching via live stream can hear the question. That would be very helpful. And please quickly identify yourself and keep your question brief.
Well, my name is Taki of Pacific Pond. Antoine, thank you very much for a great presentation. You mentioned about huge glut of gasoline naphtha pool. I quite agree. But at the same time, you mentioned about huge, steep growth of a petrochemical oil demand. I think it mentioned about naphtha. But I cannot agree in this regard. Let me say that now naphtha-based ethylene makers in Europe and Asia is suffering a lot, because the naphtha cannot be competitive against ethane-based crackers. And the Chinese, they used to have a very huge naphtha-based ethane cracking projects, but they are canceling and delaying. And at the same time, China is, I think, moving ahead from a naphtha-based ethylene to a combination of gas to chemicals and also PDH. How do you think about that? Maybe a naphtha demand for petrochemical is much smaller than you say, and maybe a gasoline naphtha market will be much more bearish.
Well, again, this is kind of one of the challenges that we face as oil analysts is to take into account the petrochemical sector, which is so complicated, so complex, and we don't really have so much capacity to do that. So in our forecast, actually, we do all of our forecasts ourselves, but to try to get a handle on the petrochemical side of things, in our report, we had to look at outside consultants, and we did buy some research from consultants to look at this. There are question marks. I mean, your points are well taken, valid, but I think now what we see is that there's a lot of condensate splitting capacity in Asia looking for condensate. and a lot of condensate in the US looking for a market. So there's a good match there, and we see a potential trade flow there that could be sustained. Now, sure, I mean, it's a moving target. There's many moving parts to this. China is looking at developing all kinds of new technologies that, like, coal to liquids, for instance, which, has not been looked at in the Western world since the Nazis. In China, it makes sense. In the Americas or Europe might not make sense, but in China it makes sense for various reasons. So we are seeing developments there that are very interesting, novel, groundbreaking, and it's difficult to guess how it will all work out. But I think we are seeing in the US petrochemical demand more for ethane and propane. We're probably going to see some ethane shipments to Europe, which is kind of a new thing because ethane was not traditionally traded across oceans in the past, but I think that's going to be something that we'll see in the next 5 years. Naphtha is not the fuel of choice for petrochemical plants in the US. It's being displaced by NGLs, LPGs. Naphtha will be available for export, and we see export potential. We see export potential in Asia. We see export potential also in other producing countries, like, for instance, Venezuela, in order to market the bitumen from Venezuela. The approach in the late 1990s was to build extremely capital-intensive, very costly upgraders, which occasionally go down for maintenance. I think in future we might see more naphtha mixing to mix with the bitumen and bypass this very costly process. So there's different outlets that we can see, but I still think we're going to see strong demand in Asia for some of the light products.
Mr. Halff, thank you so much for being here. My name is Haik Nersessian. I'm a second-year student at Columbia SIPA. Could you please comment on Russia-Chinese deal, gas deal that was signed 2 months ago, what it means for Russia, for China, for US, and for the region? Thank you.
Well, for China, it's, this is a deal that had been in the works for a long time, for years. For China, it's a nice chunk of supply. It's not a huge amount of, compared to gas demand and expected gas demand in China, it's not massive. It's part of the supply picture. It's not a game changer, really. For Russia, it's a nicely timed agreement. When Russia was looking for political support, this was a very welcome development, a very welcome closing of a negotiation that had taken about 10 years. So it's significant. I think it's part of a trend. Russia is moving more, is increasingly turning, pivoting, to Asia, so to speak. I'm not sure we necessarily see a lot more gas being traded from Russia to China because you have to get that gas available, and you can't easily trade Western gas to Asia. There's not that much flexibility in the transport system in Russia. Unlike oil, you can easily move from west to east, and we're seeing that. We're seeing less crude being exported, for instance. More than 71%, I think, of Russian crude is being shipped to Europe today, but that percentage is falling. And in 2013, Russian crude exports to Europe were down about 7% from 2012. That's been a trend over the last few years, and a trend that's will likely accelerate. And it's not a big deal for Russia to move crude trade from west to east. Gas is a different story.
Next question.
Thank you. Good evening, and thank you for your presentation. My question is connected more with Northern Europe, and we all know that there are untapped reservoirs of oil and natural gas. And my question is, how soon will the world need these entire reservoirs? What impact on economics of Europe and globe in general can we forecast? And is America interested in these entire reservoirs? Thank you.
The question, did you hear the question?
What kind of reservoir?
I think you were talking about shale. What? Shale gas and tight oil reserves in Europe. Is that what the question was referring to?
No, it's more about the exploration of these reservoirs in the Arctic.
Oh, in the Arctic.
I'm sorry, I didn't mention that. I'm sorry.
In the Arctic, got it.
Yeah, I mean, there's a lot of excitement about the Arctic. We don't see that as, really coming in the supply picture in the next 5 years. To us, it's longer term. But certainly, there's a lot of investment, a lot of interest in the Arctic, and with the kind of a warming and melting of the ice there, it's becoming easier to access and easier to transport and so on. There's many concerns, about safety, about doing it in a clean way. There's raised all kinds of issues, but I think it's going to be part of the picture, but more in the longer term, next decade, than in the next 5 years.
Hi, David Utes with the National Committee on U.S.-China Relations here in New York. I have a China question. With China such an important actor in global energy now, is it time for China to be a member of the IEA? Would that be beneficial to China? What kind of impact would it have on the IEA? And do you see a path toward that membership happening? Thanks.
So, the IEA has been engaged in the process of trying to deepen its relations with very important non-member countries, including China. Technically, it's difficult for China to become a member of the IEA because there's a requirement in the statutes of the IEA that in order to become a member country, you have to be a member of the OECD. So China is not about to become a member of the OECD, so that makes it difficult technically to be a full-fledged member of the IEA. But what I can tell you is that the discussions, the dialogue we've had with China has dramatically moved forward in the last few months. There's really been a sea change, and this is not just with the IEA, it's also with the US. And you saw the announcement this week of the bilateral MOU between the US and China about data transparency and about the strategic petroleum reserves. This is, I think, very significant development, very important news, and it matches what we see also in the IEA Chinese discussions. There's been, I'm not sure where that comes from. I mean, certainly we've been pressing China to engage in dialogue for a long time, but recently we've seen a very dramatic step up in the degree of engagement and commitment from Beijing in these kind of initiatives, and that's something we very much welcome.
I'm not sure if everyone knows about the MOU at the SNED, the Strategic and Economic Dialogue. Do you want to say a word about what it was?
Well, there was, I mean, you can say, there was an agreement signed just recently. When was it? About a week ago?
Mm-hmm. I think so, yeah.
Between the US government and the Chinese government, and this covers basically a couple of points. Cooperation on strategic reserves and also data transparency, statistical collection in the energy sector. So that's part. There's a very rich dialogue between China and Washington for a long time. But this is a very important milestone and a big step forward.
Yeah. We have a couple of minutes left. If there's any one or two last questions, yeah, please.
John Hogan, Business School 05. As a follow-up to Jason's question earlier on the sanctions, and this is probably too soon because they just announced the $100 billion BRIC fund. I guess it's probably like a bank. Is any thoughts on potential disruption to the petrodollar?
In Russia from the sanctions?
From the $100 billion, I guess it's a bank. You know what? I only read the headline. I didn't even.
From the BRIC bank, you mean?
The BRIC bank, they just announced it a day or two ago.
Well, it's a bit early. We're trying to assess what this all means. We're trying to see what the other BRIC countries think about it, and it's at this point it's not really clear. If you look at if you read the Indian press, for instance, there was barely any mention of it. So it's unclear what commitment, how different BRIC countries respond. So this is early days. We're going to watch this.
Hi, my name is Mustafa Oskanli, and we discussed a lot about China, Russia, but we didn't get to discuss much about Europe. And so from the gas side, Europe is pressuring because they are very reliant on Russia. And from the oil side, the US oil is much cheaper, so their industries are suffering because of the uncompetitiveness. So how long do you think Europe can avoid shale gas and oil production?
Well, Well, parts of Europe are interested in shale, but there hasn't been, Poland, for instance, has been open to developing its shale resource, but there's been no success, no major headway there. At the other end of the scale, a country like France has a large unconventional resource, at least potentially, but there's very limited public support for it. There's a moratorium against fracking in France. I think, many different parties, both in government and in the private sector, would like to see some movement in shale in a place like France, for instance. It's going to take some time because, again, the environmental movement is very much opposed to it. It's quite influential, and there's even within the Socialist Party, which is the governing party now, there's different views on this. But the majority view is, well, this is something we will consider in the future when the technology improves and becomes environmentally more sound, but let's not do it right now. So I think it's going to take some time, right? But it's true that the development in the US, the growth in refining, not just in the US but elsewhere, is really having a big impact on for instance, on European refining. Lots of closures that already have happened. Many refineries, I think 16, 17 refineries have already closed since 2008. Many more will probably close in the next few years. So this is causing some hand-wringing in the capitals, in terms of energy security, in terms of labor, job cuts, and so on. But at the same time, facing this kind of issue can be an opportunity. And if you look at, in terms of moving towards greater efficiency, and if you look at economies like Japan and Korea, those are economies that have been built historically on extremely energy-intensive industries, despite a complete lack of energy resources. So being seemingly at a disadvantage in terms of access to cheap energy supplies is not necessarily something that condemns you to failure in terms of the success of your industrial or economic policy. And again, Japan and Korea are really the illustration that you can really get around those constraints and come out on top.
So if we keep the questions and the answers brief, we'll get through 3 questions in 6 minutes. Please.
I have a question regarding the LNG pricing, especially related to Asian market. Right now, we are looking at a lot of different scenarios after the 2020 when the window period of LNG demand start loom, and there is a lot of tension regarding what this scenario will develop, especially when it comes to U.S. export to Asia. And so what's your comment on that? Do you think the Japan crude cocktail linked pricing will continue, or do you think there will be a regional hub pricing? Yeah.
Well, we're doing a lot of work on this. The IEA does a lot of work on the gas market, Asian gas market, developing an Asian gas market. There's a lot of interest in the capitals, countries like Japan in particular, very interested in trying to develop an LNG market. It's going to take a lot. It's going to take, first of all, pricing reform in the domestic gas market in Asia. It's going to take building of infrastructure. You need to have storage. You need to have a system in place. So it's not an easy process, but there's a lot of political commitment to it, and we at the IEA do a lot of work on it, and we're ready to support and try to provide guidance and political and economic analysis to support this.
And it's something the Center will be working on actually with the IEA.
Right.
Yeah. Good afternoon, Robert Murillo, MUFG Union Bank. I was wondering if you could expand a little on your assumptions regarding climate change and the possible policy or lack thereof in relation to climate change, how it's impacting supply and demand of oil and these resources during the period you're covering.
Right, so for the medium term, right, which is our focus, 5 years, we don't see any impact. I mean, we haven't assumed any big change in carbon pricing, for instance, and we don't see it as really affecting investment for the medium term. It's a big deal for the longer term, and something that the World Energy Outlook looks in detail. But we don't see it as really having an impact short term.
Hi, my name is Gianna Chaboni. You discussed how natural gas has kind of forced this competitive pressure against oil companies in recent years, and in the past 5-10 years, If you're doing forecasts, you probably never would have expected this. I know that a lot of the world didn't. My question to you is this: do you expect other fuel types, other alternative energies to ever have this kind of impact on the oil, such as, you know, wind and solar? I know that South Africa was just named the largest, you know, incoming country for solar energy. So I was just wondering if you might see this kind of impact in the next 5, 10, 15 years.
Well, you know, wind and solar, I mean, that's something that we have another division in the IEA, publishes another medium-term report, which is the medium-term renewable report. That's due out next month, I think. And, but this is not something, in our view, wind, solar, doesn't really compete against oil. You know, I know there's countries like Saudi Arabia is looking very much at solar, even wind, to try to free up some oil for export as opposed to power generation. But on the larger scale of things, we think that gas competes with oil in transport, but you know, we don't see too much effect from hybrids or electric vehicles in the next 5 years. We think it's going to be marginal. And solar, wind, renewables in power generation, major impact, big deal, major growth, but not so much affecting the oil market.
Great. We are 1 minute early, but that was a really sweeping overview of the entire world and the supply and demand outlook, and it gives us a lot to think about. So I learned a lot. I hope everyone else did too, and I really appreciate your traveling to Columbia to be with us today. So please join me in thanking Antoine.